The 2023 stock market has continued its strong start relative to the 2022 bear market. Over the past 2 months, my dividend stock portfolio has increased over 10% in value. That beats the S&P 500, which saw a 5% rise in the same time. My portfolio's recent performance can largely be attributed to Microsoft, which is my largest position. Microsoft's stock price has grown over 24% in that 2-month period. While this is nice to see, I would actually have preferred for Microsoft stock to go down so I could buy more at what I think is a fair price. That same logic goes for many of the stocks in my portfolio. That said, stock market prices are volatile and these gains could easily get wiped away in the coming months. However, the underlying growth of the stocks I invest in will not be wiped away. Many of my holdings have continued to grow their business with increased earnings and dividends despite the bear market. This is real value creation regardless of stock price fluctuations. In today's video, I'll share an update on my entire long-term dividend stock portfolio and explain the real growth happening under the surface. At the end of the video, I'll share some wisdom from the legendary investor Peter Lynch, who just made a rare television appearance. Make sure you stick around for that. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe if you enjoyed the video. To support the channel, sign up and become a member of my website, dividenddata.com. Here you can track multiple portfolios and get dividend-focused analytics that are often neglected in most brokerages. On top of this, you can use my advanced stock research tool, which I designed to help easily analyze a company's financials. This lets you put your focus on what matters most, the actual business fundamentals and the cash flows they produce. I am constantly working to improve dividenddata.com and future updates are actively in development. This includes better user experience, more features, and more value. By becoming a member, you also gain access to an exclusive Discord community with over 1,300 investors. Here we discuss investing strategies and share our new stock buys, sells, and dividends. In this community, we support each other along our investing journeys. You can sign up for dividenddata.com at no risk, as there's a 30-day money-back guarantee. Links in the description and pinned comment. Also, I have an important update to share for returning website users. If you have not already re-registered your account, you will need to do so. Use the same email and all your data will sync automatically. Most users have already done this, but I'm just spreading the word so more remember to do so. Now let's dive into my portfolio. My current total value sits at $122,478, with $95,330 initial dollars invested. This puts my total return at 28.48%. That is over a $27,000 unrealized gain. My top holding, Microsoft, now has a current value of $30,818. This gives me a 26.46% total return. That's not bad given the overwhelming majority of the position was invested in fall 2022. Of course, these gains are just on paper. Microsoft is a core long-term holding. My second largest position by value, ExxonMobil, is still crushing it from the oil boom, giving me a 221% total return. Altria is a steady cash cow, which paid me a massive dividend this past month. More on that later. Disney is my worst performing investment, down over 31%. However, I do think that the worst is behind them, as they now focused on cutting costs and streaming profitability. I'm basically flat on T. Rowe Price, and I'll likely buy more soon. I'm up over 38% on Apple. They report earnings later this week, which will be very interesting. I would love to add to my Apple position on a sizable dip. I'm up 11% on Broadcom, and I'll likely be adding to that position. I have a 6% total return on Texas Instruments. The stock fell after their recent earnings, but I'm being cautious and waiting for it to fall more before buying again. With the recent trend of earnings decline, there could be a really good buying opportunity in the next few months. I'm up 15% on Visa, which is one of the best dividend growth stocks. I'll explain more about that later in the video. Finally, I have large gains on Kroger, PepsiCo, Chevron, and EPD. With these, I have not increased my investment in a few years, aside from reinvesting dividends. Overall, my portfolio is heavily weighted towards technology. This is followed by energy, but mostly due to the large gains in that sector over the past 2 years. I am heavily concentrated with my top 3 stocks, representing over 50% of the dividend portfolio's value. Speaking of dividends, my projected annual dividend income now sits at $3,351. This is $837 every quarter, $279 every month, $9 every day, and 38 cents every hour. This is truly passive income earned from my ownership stake in these great businesses. In May, it will be my lowest month in the dividend cycle with a projected income of $104. This will include dividends from EPD, Texas Instruments, and Apple. However, June will be a great month for dividends. Here you can see a detailed look at each of my stocks' dividend income, current yield, yield on cost, and the impact of reinvesting dividends. My largest payer, Altria, is expected to generate $1,161 in annual income. I reinvest all of these to acquire more shares and increase my future income. In April, I earned $280 in dividends from Altria. I reinvested this to buy 5.89 more shares. That is serious compounding. I now have 24.79 shares of Altria derived from dividend reinvestment. Among dividend investors, we call these DRIP shares. You can manually track these on dividenddata.com, which is not offered on many services or brokerages. Thanks to DRIP shares, my dividend yield on the initial cost invested in Altria is now 9.4%. This is a 0.75% increase in yield compared to not reinvesting dividends. Us dividend investors call this dividend reinvestment impact the snowball effect. If you want to see a full explanation of this concept, watch a video linked here. In total, I've earned $8,681 in dividends since starting this account. In 2022, that was $3,297. So far in 2023, I've earned $1,168. In April, Altria was my only dividend, bringing in a massive $280. I'm looking forward to this growing into the future. Since my last portfolio update, which was only a few weeks back, I have not bought any stocks outside of reinvesting dividends. This is due to an increase in the price of most of the stocks I was targeting. Over the long term, I'll continue to invest regularly in companies I view as high quality and fair value. Now let's get to the topic of the day: the underlying growth of my top dividend stocks. Novice investors often just have the surface level analysis of looking at stock prices. However, the reality of investing is deeper than that. Ultimately, a business's value comes from their ability to generate cash flow. This cash can then be used to reinvest back into the business or reward shareholders with dividends and buybacks. Therefore, the growth of earnings is a key metric for long-term success. Many of my investments are in companies whose industry is seeing large secular growth trends. For example, Microsoft is powered by the growth of the cloud and enterprise subscription software. Since 2015, this has turbocharged Microsoft's earnings growth, as you can see here. Despite overall growth slowing in 2023, Microsoft is still benefiting from these trends. In Microsoft's 2023 Q3 earnings report, Azure Cloud Services reported revenue is up 27% year over year. This powered Microsoft's Intelligent Cloud segment to 16% revenue growth year over year. That is their largest business segment, seeing high growth. Microsoft 365 commercial revenue grew 14% year over year. This pushed Microsoft's second largest segment, Productivity and Business Processes, to 11% revenue growth year over year. This is real growth while the economy is actively working against them. The tech sector is experiencing its worst crisis since the dot-com bubble. Companies are cutting cloud spending, tightening budgets, and laying off employees. Despite that, Microsoft's cloud and enterprise software are still growing. These are long-term trends that will continue into the future. Microsoft may have even found a new growth trend with artificial intelligence. At a minimum, AI will accelerate their existing growth drivers by increasing cloud demand and improving Microsoft's suite of software. This is already being seen and just scratching the surface. Microsoft's reliable and growing cash flows will reward shareholders. They are a cash cow. The money just keeps piling up, now at over $104 billion in cash on hand. The Microsoft dividend is growing at a 10% 5-year compound annual growth rate. This is growth of real cash paid to you, the shareholder. Other examples in my portfolio of high-growth dividend stocks include Visa, ticker symbol V. This company is benefiting from the global shift to digital payments. As the leading digital payment network, Visa is well positioned to profit from this trend. I recommend you watch my Visa stock review video for a detailed explanation of their business model. That said, the financials don't lie. Visa's earnings are growing and blowing past their all-time highs. Free cash flow per share is growing at a 19% 10-year CAGR. This means massive dividend growth as well. Visa's dividend is growing at an 18.49% 10-year CAGR. They just had a 20% increase 2 payments ago. Another stock example here is Broadcom, ticker symbol AVGO. This company benefits from both the growth of semiconductor demand and the growth of enterprise software. Again, check out my full stock review for more details. However, the financials don't lie. Their earnings growth is immense. Broadcom is a cash flow machine. Over the past 5 years, free cash flow per share is growing at a 24% compound annual growth rate. Broadcom's dividend is growing at a 21% 5-year CAGR. Microsoft, Visa, and Broadcom are just some examples of companies I own with quality businesses that will keep growing into the future. When investing long-term, this business and earnings growth is vital. Now some of you will be thinking, but Zach, you own Altria, and smoking rates continue to decline. That's true, but Altria's earnings continue to grow at a reliable, slow rate. This is while it trades at a very low valuation relative to cash flows and dividends paid. The company is even investing in new markets for future growth. A growing business will become a massive tree towering over its former self. From there, it will bloom large dividends you can harvest. The importance of growth is recognized by the world's best investors, including Peter Lynch. Lynch managed Fidelity's Magellan Fund from 1977 to 1990. Under his 13-year management, the fund earned an annualized total return of 29.2%. Despite being a great public speaker, Lynch is very private since retiring. However, he just appeared on CNBC to give a new interview. I'll play a clip where he shares some of his investing wisdom, including a point on the importance of business growth.
Well, I think people, they're investing in individual stocks. It's sad they're careful when they buy a refrigerator or an airplane flight. They're careful with their money, and they'll hear about a stock on the bus, and they'll put $5,000 or $10,000 on it. They have no idea what they do. So you're really got to be careful. Look at the company, look at the balance sheet. What is the reason the stock should be higher? The sucker's going up is not a good reason. Well, I think looking for something different, looking for something that's a good story. I mean, who would have guessed TJX, a local company, would have gone up 50-fold, or Stop and Shop would go up 10-fold, or Analog Devices, or NVIDIA. I couldn't pronounce NVIDIA. So you have to find a company that's either a turnaround or a company that's going to grow, like Panera or, Family Dollar stores. I'm not saying that buys now, but that's what's made our, Sears is rolled over. So Kmart's rolled over, IBM slowed down. But we've had new companies come along. I mean, that's the nature. You have to be looking for new companies and look at the balance sheet. If you can add 5 and 5 and get reasonably close to 10, you should be able to look at a balance sheet and say, here's 2 depressed companies. They've gone from 50 to 3. One company's got $3 million in cash and no debt. One's got $3 million in debt and no cash. Which one are you going to buy? I mean, that's not too hard to do.
Lynch made a killing off of simple retail stores like TJX, Taco Bell, Dunkin' Donuts, and Panera. These companies saw reliable expansion over decades, leading to large earnings growth. There is nothing sexy or magic about these investments. They are boring, but real. Over the long term, a quality, growing business so overrides any short-term price volatility. That said, there are always negative economic news and recessions that can scare you out of investing in these businesses. For example, the 2023 bank run. As Peter Lynch famously claims, quote, there is always something to worry about.
We've gone through other crises. Some banks will go under. 400 went under after 08, 09. Now we have stress tests. I think the banking system has improved. There'll be some companies go under. That's the nature of it. It's nothing like Imagine 1980, 81, we had double-digit inflation, double-digit unemployment, and people worried the Japanese were going to take over the world. I mean, we were hopeless. I mean, there's always something to worry about. I'd really, in my over 50 years of doing this, I think I'd be worried if there was, somebody didn't bring up something to worry about. That's the nature of the business. Well, we've had 13 recessions since World War II, and we've had 13 recoveries. Maybe we're going to have one. If this is a recession, it's probably the most predicted one ever. I never know when we're going to go. I'd love to know the future. I think it would help. I'd be a better investor. I'd pay $5 extra for next year's Wall Street Journal. It would really help. Right. I cannot predict the future, but this recession is so expected, so predicted. Maybe it's coming. I don't know.
Nobody knows what's going to happen to stock prices over the next few months or years. However, that doesn't change the fact that there is real economic growth happening at countless companies. This is value creation happening under the surface. Going forward, I will continue to invest in quality, growing companies at fair prices. My dividend investing journey is just beginning. Make sure to subscribe to the channel and follow along as you invest. You can sign up for dividenddata.com to track your portfolio and research stocks just like me and join a Discord community of like-minded investors. Follow me on Twitter for real-time dividend news, and thank you for watching.